we have been talking taxes all week, getting you ready for tax day, which is April 15th, and it's now less than 2 months away.
Oh, it's coming quickly. Now, we know it can be overwhelming trying to get all your needed documents and information together because a lot of stuff is just everywhere.
Yeah, it sometimes comes in the mail, sometimes comes in your emails. So, John Karp, you are a tax partner with Whitley, Penn. You've been with us all week tackling tax basics. We've talked about filing statuses, and now we are talking about tax credits versus tax deductions. It sometimes gets a little complicated, but first of all, just talk about deductions. And should folks itemize, or should they just take that standard deduction?
You know, for what happened in the Tax Cuts and Jobs Act is that it closed a lot of taxpayers out of itemizing. So when they raised the amount of the itemized deduction to $13,850 for single and to $27,700 for married, right, and then $20,800 for head of household, like all of a sudden it takes a lot to get there depending on how much mortgage interest and real estate taxes you have and how modest your house is, because it just takes a lot to get there. We watched a lot of people just stop itemizing.
So John, I guess the question becomes, what are some deductions people can claim, and what should they maybe not be thinking about? And could there be deductions if their filing status changed since last year, like let's say a spouse died or they got divorced?
Well, there's really not a lot of deductions you can get, but it may change your standard, right? So your standard may go down, so then your itemized may go up, because you still may have those itemized expenses and you're over $13,850 the year after death. When you're looking at deductions and itemized deductions and you're thinking, okay, I have charitable deductions, a lot of people always remember the checks they write, but they don't think of what cost did I incur, and did I have mileage, which is 14 cents a mile, or actual gas expenses. And they say save your receipts, keep that mileage log. The other one is student loan interest, that if you have student loan interest, remember it's up to $2,500, and you don't have to itemize for that.
Okay.
That's not an itemized deduction. And the same thing with like if you're a school teacher, that's $300, and then if both of you are school teachers, it's $600. And there are several other deductions on that Schedule A that if you look at it, but they've taken away a lot.
Yeah.
Like you have your mortgage interest and you have your real estate taxes.
And like you said, it takes a lot to itemize all those and meet those thresholds to make it worth itemizing versus doing the deduction. So let's talk about the difference between deductions and credits, because I know there's a lot of talk about some different tax credits right now, but just explain the definition difference. What are the differences?
So the difference is a tax deduction offsets, it's just an offset to income. So if you're in the 25% tax bracket, you're saving 25 cents. And I always have clients call and say, hey, I used to have this all the time. Hey, how much can I contribute to not have to pay tax? And it's a losing proposition. You contribute because you're philanthropic, because where in the world would, if you give me $1 and I hand you 75 cents, is that a good deal? No, it's still you're buying the deduction. Versus a credit is a direct offset. So if I owe $100 and I get a $100 credit, that just offsets my tax.
Okay, that's very well put and very easy to understand.
Yeah, for sure.
One tax credit getting a lot of attention, obviously, is the child tax credit. And currently, there are some changes to the child tax credit being talked about by lawmakers. What could those changes, John, look like?
So what's going to happen is, so right now, the changes really are how much cash you get back. The credit's worth $2,000, right? And that actually doubled with the Tax Cuts and Jobs Act. It used to be $1,000. And so the credit going forward, if they have the law changes, will add $200 to that. And so now you would get, instead of $1,600, which is a refundable. So there are differences between refundable and non-refundable. So there's a portion of the child tax credit that is refundable. And it's up to $1,600. So they'd give you an extra $200 back. You get 18.
And the other part of this that's kind of complicated is these changes are still being talked about, and we're literally filing taxes right now. So you were talking to me, during the break about it kind of depends on who you ask as to whether you should file now or maybe wait and file an extension and then wait to see what the dust does on all of this legislation.
It does. If you watch the news at all, besides this news channel, what you'll see is there's pictures of Danny Werfel, the IRS commissioner, and what he says is, everybody file. We'll figure out how to get you your money. Now,
do you trust that?
Right. So they did a poll of a bunch of practitioners, CPAs and practitioners, and they said, what do you think? Well, 50% said file, and 50% said wait.
Huh.
So if you wait, you would basically be filing an extension.
Right. You'd be filing the Form 4868, an extension. But again, if you're really looking forward to that refund, and since I just told you it was $200 more, and you're getting the $1,600, and you're just waiting for the $1,800, then perhaps you'll take that gamble because you're going to get your cash now.
A lot of people need that money. A lot of people are waiting on those refunds to come from the IRS. Yeah. We've been waiting for people to submit their questions, and we got one for you, John. This question is from Lisa, and Lisa wants to know, why did they change the age for the child tax credit to under 17? This is Lisa's words. My 17-year-old is still in school. She's 100% a dependent with no job.
You know, Lisa, what I'm going to tell you is I really don't have a good answer for you. And if you're only paying through 17 or 18, you're really lucky, because most of us have kids that we're still paying long after 17. You know, so I did look this up because I was fortunate enough to have this question a little early, and there's all kinds of conjecture. Maybe it's to get you ready for adulthood because it's that bridge. You know, 17 is when you can be tried as an adult, but really all they're punishing is the parent. So. But there's really no good reason that I could find in the legislation of why it's 17. So
that child tax credit that we're talking about, it is only available to parents with kids under the age of 17?
Yes, but there's another credit you can get which is worth about $500 for your child that's over 16, that's 17.
Well, that's good to know.
Yeah.
Okay, meantime, just like Lisa's case and every other case that we've talked about this week, we know that taxes are a case-by-case basis, and so much can depend on filing status and other elements.
That's right. So, I mean, it's really important to consult. There's free sources, and like one of them is VITA, V-I-T-A, and you can look it up online, and it'll tell you where you can go get help, because, you know, there's phase-outs in all types of credits and itemized deductions. There could be phase-outs and changes, and it's important to just not say, oh, I heard this yesterday, right? This is what I should do, because it could change.
Yeah.
It changes. only thing constant in life is change.
Yeah.
John, once again, thank you for educating us, and thank you for answering a lot of questions that a lot of people out there obviously have with the April 15th deadline coming quickly.